Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review, this time for the week ending May 17, 2024. So again, an interesting week. This week we had the publication of the Global Fund Manager Survey from the Bank of America, so we'll be digging into that. It's a good way to feel what's priced into the markets and where investors are positioned. Very interesting tidbits here. There's a lot of optimism on Wall Street. We'll look at that in a few minutes. We think it's warranted, mostly because if you've been following us in these reviews for the last few weeks, or if you're reading our monthlies on iagam.ca, you'll know that we've been looking at the manufacturing cycle over the last few months, and we're seeing like the diffusion index, the number of countries where we're seeing an acceleration in manufacturing. It is on a strong uptrend, and it's led by emerging markets. China's manufacturing sector is getting better. We're getting anecdotal evidence in Europe that demand for exports by China is rising, so China is buying more from Europe. So you're seeing this background of a new economic cycle that's taking shape. Commodity prices are rising. We've been talking about copper. Here we added some more to our position on copper over the week. We think that the price action and the story that is unfolding before us will continue to be beneficial to the price of copper. Gold is rising again. Price of oil is rebounding this week. So you're seeing, it's not just tech, it's not just NVIDIA and AI, it's broadening on the economic sense, and it's broadening also in the markets. And if we look at this week's markets at the close on Thursday, so of course the depricing of the Fed and the Bank of Canada that we've seen since the beginning of the year. Remember that when we started the year, it was 6 or 7 cuts that were expected by the Fed. We thought it was way too much, while the market changed its mind, and of course rates are higher. So you get some red on the screen for that. But for equities, big week again on the markets. But if you look at the year to date in local currency, Europe is leading in this chart here, and we didn't add Japan, but Japan is even stronger than Europe. So it's not just tech, it's like the more cyclical indices are doing well this year. The TSX, it's lagging a little bit, but it's still somewhere in the pack here. So markets that are broad are markets that are strong, and we're seeing this broadening of the themes that are supporting the market. So there's good news. There is ample good news here for investors. Price of oil higher on the week. USD is getting a bit weaker versus other countries. This is what you get when the global economic cycle is finding its footing. So capital is just getting out of the US and being invested elsewhere in the world. So higher for the CAD, higher for Euro, and the price of gold starting to get back, creeping in slowly to the 2400 level that we touched a few weeks ago. So now for the charts, Global Fund Manager Survey from Bank of America. Here you have it on the first chart. This is the composite sentiment index that they're building, and it shows that it's the most bullish since November of 2021. So investors are optimistic. Interestingly, late 2021, if you remember, markets were very expensive. Markets were moving in a straight line higher, and we knew that rate hikes were around the corner, but markets were not pricing them in yet. So there was some exuberance. Now this year, when you look at the setup, we had a pullback in April, which kind of just reset the valuations of markets. So we're seeing ample optimism. We're seeing the global macro story that's broadening, and we're seeing valuations that make sense, or that make more sense than they did in late 2021. So there's still room for more optimism, even by investors here. And of course, markets can be volatile. Markets don't rise in a straight line, but you have an interesting setup for continued gains as we move forward in the year. And next chart here, we see that market participants have priced out a recession. So over the last few months, the crowd that thinks that we're heading towards a hard landing has shrunk recently. It's pretty much stable at the current levels, at the yellow part on the chart on the left. But more investors are seeing more no landing or a soft landing scenario. And on the right, the percentage of investors that are seeing a recession over the next 12 months, well, it has dwindled to the lowest over the last few months. Now it's about 2/3 of investors that see no recession, and I think it's fair to see no recession in this environment. That would take quite a surprise for the economy, the global economy or the US economy, to fall into a recession over the next 12 months, given the impulsion that we have right now. In Europe now, we've been mentioning over the past few weeks that European data is getting better, but Germany was still a bit of a weak spot. When you look at surveys of expectations, so forward looking, we see that there's more and more optimism from investors over there. This is the Zoo survey of economic expectations. It's a 10th straight month of rise for this survey. So good things are happening over there. The details of the survey, you have some anecdotes in there, and this is one I was quoting a few minutes ago, that the demand for German exports from China is getting stronger. So, there's the benefit here of global trade, which should help Germany over the next few months, or at least the expectations are getting stronger. Now turning to the US, we had the US CPI this week. Not much progress on total inflation. That's the chart on the left, year over year, pretty much going sideways. But on the right, maybe a positive signal, but I would say it's still weak, it's still nascent. Core and super core inflation, when you look at the 3 months annualized figure, so the recent pace or the impulse of inflation, well, we were worried about how quickly the reacceleration was, especially on super core in the latest numbers since mid 2023, but now seems to be taking a pause. So easing a bit in April is still much too weak, a slowdown, or rather the levels are still much too strong for the Fed to change its mind here. We don't see a cut by the end, before the election for sure. Might squeeze a cut in December. Maybe we won't have a cut in 2024. It's going to be a 2025 story. So there's nothing here to change our mind. But it's still good news to see a pause in the jump in supercore inflation 3 months annualized. So what we'll be watching next week in Canada, we'll have the CPI report. Very important report because it's the last major data point before the June 5th decision by the Bank of Canada. We've been very vocal that we think that July was the set date, but given the recent data points, given the recent messaging from the Bank of Canada, it's pretty much a coin toss between June and July. So the door is fully open for a June rate cut. We'll see with this inflation report. If we get the 2.7% year-over-year print that's expected, that should be good. 0.5% month over month, that's a bit on the hot side. So we'll see where we come out, but next week we should have everything we need to make an informed call on the odds of having a rate cut on June 5th in Canada. Retail sales should be a bit weaker. In the US, we'll have the manufacturing and services indices from S&P Global. New home sales and the University of Michigan sentiment survey crashed last month. There was a change in methodology, so now we'll have to see for the next few months if it is noise from a change in methodology, or if really we're catching more downbeat US consumers. It's a question that's still up in the air, but it's going to be an interesting one. Could create some volatility in the markets over the next few weeks and months. So that wraps it up for the week. Always a pleasure to serve you. If you enjoy the content, please share, and of course, please be back again next week.